Hey guys, today we're going to talk about something more legal, so something different than usual probably, but something that touches the lifespan of every startup out there as far as I know. And the topic is stock options for employees, right? Which is something like maybe very complicated. So today I want to break it down in a way that I'm going to highlight what are the main variables, the main terms into any stock option, in a way that you have like an idea, benchmark of what is reasonable and what are the best practices in the field. I'm going to report based on what I read, what happens in the Silicon Valley, as well as from personal experience by giving like stock options to our employees. So I have like a little bit of both of the perspectives. So I'm going to try to give you like an outline of what's possible. So first of all, you need to keep in mind that stock options are nothing else than a contract. So the terms that I'm going to discuss in a second are nothing else than the terms of the contract that can be adjusted to, to the case, to the type of company and type of employee. But I would say you have like a very high degree of customization. But the option, what you cannot customize, is the way an option works. That is, you assign the right to a person, the holder, to buy a certain underlying asset, in this case the shares in your company, at a price that you decide today, and the bet for the holder of the option is that the price that of the asset tomorrow is going to be higher than the price of the option. So in a second we're gonna walk through all these terms. So first of all, we need to decide who deserves the options, right? So you need to identify what kind of company you want to build. This really depends on the culture, and the choice of who you want to entitle with stock options will also determine most of the terms you're going to choose for those kind of contracts. Usually the common practice is to reward with stock options early employees. I would say like the first up to 10 employees beyond the founders. Why? Because they are they basically are like founders, or they've been working as founders. So you want to make sure that you keep them throughout the life of your startup, right? So if this is the case, then you should definitely make sure that they feel rewarded and they feel like that they're going to take part of the gains of an exit. In some companies, stock options are just given to all the new employees, irregardless. So also this also implies that the terms are stricter because you're basically giving away shares to everybody. So you need to make sure that not everybody can actually get them. I heard that in Uber it's kind of common practice to give options to everybody, but they also give very strict terms to convert them, or in case they leave earlier. So as you will see later, this is going to be more clear. So first of all, who? The second point is how much. So how much in terms of equity percentage will the contract, the stock option, entitle the holder to? There is no common rule on this. It really depends on the person that is getting the options. For some ideas, you can also look at angel lists. There are like some offers for developers, these kind of things, with stock option ranging from 10% of the equity to 2% of the equity. Keep in mind that 2%, or whatever percentage it is, needs to be converted in a number of shares at the moment in which the option is issued. And this is very important, right? Because percentages are relative, but number of shares is nominal, and that's fixed. So if you issue the option today, it's gonna have a certain number of shares underlying, and that number is fixed, meaning that the holder of that option, so the potential buyer of those shares, is also subject to future dilution, just like any investor that would invest today for the same number of options, right? If you would just like say 2% or whatever percent, then basically you are like, they're not diluting, and well, I would say it's very, very favorable in the terms of in the perspective of the employee, not in your perspective as a founder, nor in the perspective of investors. So if they, they're most likely going to stop you whenever you try to get their approval. Another important aspect of how to say the basic terms of any stock option is the type of shares they're going to give, or you're going to basically they're going to be underlying the contract, right? So it can be common shares. I would say it's never ever preferred shares, and that's not the case. That's something that you only give to VCs or other kind of investors. So it's always like the junior level shares or common shares, or even a step below, there can be non-voting shares. So meaning that they are not entitled to vote even when they convert, right? This is common practice in some geographies. It's also common practice to make a you have to do a option pool, meaning that you reserve a number of shares for any stock option holder of the future, and that pool is allocated in a separate entity. So when you get like a stock option, you don't get like the option on the shares directly that this company owns, but rather on the shares or certificates can be of this new entity, right? This is the case of a foundation. So let's say you allocate 10% to your option pool. So that 10% from your company goes into this foundation, and the foundation then issues stock options on the certificates of the foundation. So the foundation is going to be managed by the company, and the employee will own certificates in this foundation, right? Meaning that it's going to be entitled to all the economic rights. So any exit, any upside is going to be just like shares, common shares in your company, but it will have less impact in the business decisions. So this could be advantageous, especially in the perspective of the founders and investors, right? It can be pretty troublesome to make every single little investor to vote. Then they probably would spend more time doing administration than running your company. So that could be one of the ways to go about that. Another very, very important term, I would say one of the most important terms of any stock option contract, and what separates this type of contract from any other, is the strike price. Meaning that when you issue the option today, when you enter the contract, you decide at which price the holder of the option will be able to exercise the option, right? So if you're giving away 10,000 shares, right, that are part of the option, you also need to determine at which price they're going to convert, right? So you can say $10, €10, meaning that as long as the price at exit, or whenever there is, whenever the employees get to sell the shares, whenever the price is higher than 10, then he's going to get a capital gain, and as a consequence, an economic benefit. So how do you determine the strike price? There are different ways to go about that. In most geographies, it's something that the managing directors or the board of directors of the company determine. So if you're issuing the stock option today, let's say it's 1st of January 2017, then you should rely on the fair market value of the company at that time. And how is that determined? Well, it can be determined by the board of directors. It can be determined by an external company. It can also be related to a recent funding round, right? So usually in the States, at least, this is determined once a year as part of the disclosure for the 409A, which is a part of the income declaration of employees for stock-related compensations. I will not dive too much into the details of this, also because it's not my field of expertise, but there are companies taking care of this aspect for the startups, and this allows also the startup to pass on the responsibility to the other company. In most cases, it's as simple as relying on a fraction of the last funding round, especially when we're talking about like valuations that we know being probably determined by the momentum, so what the investors are willing to pay, but that may differ from the fair market value. So it can be a fraction of that. It can also be that the valuation firm, or whatever firm does it, has to use other types of valuation. So this is something important, but the principle, I would say, is keep it fair, and that's why it's called fair market value for two reasons. A, in the perspective of the employee that gets the option, and B, in the perspective of tax reasons, because if you misprice that, or like largely misprice, because there is like quite a margin of error, then you may run into some kind of auditing. It's rare, but it can happen. Okay, so once you have the person you want to give the shares to, how many shares it's gonna get, that is fully diluted. Sorry, I have to read all the points. You know the type of shares you're gonna give, like common shares, other types, non-voting shares. You know the strike price. So now what you need is a vesting period or vesting schedule, right? Meaning that it's not that you give the option for 10,000 shares and from day one the employee will get the right to exercise those shares at exercise date. No, you give them 10,000 shares that they're going to be vested, meaning that the right to exercise that full number is going to accrue over time, right? So what's the average duration for that? Everywhere I read, I see 4 years, meaning that 10,000 shares will only be exercisable in full at the end of the 4 years when the exercise date is set, right? And another aspect is the cliff. It's also called the cliff, meaning that a period, a threshold before which, if the employee leaves for any reason, the option holder leaves, then he loses the right to the all option. Usually that is set at 1 year. So if you stay for the company less than 1 year, then you lose the entire right to the stock option. You just lose it. So so now we have like a vesting period. So we said usually it's 4 years with 1 year cliff. At the end of 4 years, there is the exercise date from which the employee can exercise the options, and later on we're going to see what is the duration of the exercise period, because that's also a very important term to discuss and to include. Now we need to also determine which kind of vesting schedule we're going to follow. So, okay, we know the 1 year cliff, but that's different. What we can decide among is it going to be linear? So the 10,000 shares that we mentioned before, are they going to accrue on a monthly basis every year, every month the same over the next 4 years? That's one way of doing that. And also you need to determine what is the vesting unit between within that the period of 4 years, right? So if you say it's going to be linear, so every month the same, when are you going to count for the options, the shares as vested? Is it going to be every day? Is it going to be every 2 weeks? Is it going to be every month? Usually it's every month. It can also be every quarter, every 6 months. What does this imply? Well, it implies that if you have like a monthly schedule, right? If the employee doesn't reach the end of a certain month, then it doesn't get the option, the shares of that 1 month, right? Meaning that if you have a quarterly investing, then if it doesn't reach the end of a certain quarter, then it doesn't get the shares for the entire quarter, right? The other way of doing that, well, you can be actually quite creative with this. It can be linear, but it can also be non-linear. And an example or something I read quite recently, and I heard that Snapchat is using that, is called the back-end loaded. Back-end loaded means that you still have the 4 years of vesting, but every year has a different percentage of the 10,000 shares in this case that vest, right? So in the case of Snapchat, I heard is 10% the first year, 20% the second, 30 the third, and 40 the fourth year. Why this different type of vesting compared to the linear is very simple. You want to keep the incentive for the employee to stay as long as possible with the company, even after the cliff, right? So in the case of Snapchat, let's say you have 10,000 shares, so you get 2,500 shares at the end of the first year. If it was linear, so you pass the cliff, so that's what you're entitled to. With Snapchat, you just get 10%, so you just get 1,000 shares, and then it goes up faster later on. So that's called the back-end loaded, something that I came across quite recently. I think it's very smart, and this is just one of the examples of how creative you can be, because in the end of the day, you are tailoring the contract and you can see what works best for you, right? Your lawyer can advise you, or you can just find some material, or you can even, like, for instance, use this video, right? Okay, so now we covered all the aspects from granting the option to the period of vesting. So what happens after the vesting period, right? So as I mentioned before, there is the exercise date. So from that moment on, at the end of the vesting, the option can be exercised, but it cannot be exercised forever. That's where the exercise period or the exercise duration comes in. And this is like a very, very tricky aspect, right? Because in any option contract, you are expected, as the holder of the option, you are expected to pay the strike price, right? Cash, meaning that if you have 10,000 shares that vested and the strike price is 10, then you have to pay 100,000 cash to the company, right? Doesn't it sound like a contradiction compared to the fact that stock options are supposed to, give incentives, when companies cannot pay in the form of cash? It kind of does. Truth is, if you extend the exercise period long enough, you can give time to the employee to wait for an exit when, let's say that the exit gives a price pressure of 20, very, very simple. So the employee can buy shares because of the option at 10. So he's supposed to pay 10, but at the same time he gets 20. So instead of getting 20 and paying, it just like nets out the equation, right? So he gets 10 net out of that, without having to pay upfront cash and taking the risk of not being able to get any good exit, right? So that's why I'm saying it's a very, very tricky aspect, because depending on the kind of people you want to give the option to, the kind of company you want to build around the stock option aspect, that exercise date can really make the difference, right? The longer it goes, the more similar it gets to actually owning shares, directly shares in the company, without actually having the voting rights, these kind of things. But it's very, very similar if you think about that, with the only difference that the owners of a share gets, in the case of an exit as before, gets 20 out of 20. You get 10 out of 20 because you have to pay the strike price. Still, considering that you didn't have to do any, well, that's not true that you didn't have to do any effort, but consider that it was meant to give you the financial upsides of an exit and keep the incentives aligned till the exit. Well, it kind of worked out, right? Yeah, about this topic, I forgot to mention that I heard and I remember reading that, for instance, companies like Uber that give stock options quite to everybody that joins the company at a certain level, they give an exercise period of only 90 days after the exercise date, at the end of the vesting. Why? Well, because probably they're giving away so many that they don't want to have like bad surprises for the investors later on. I mean, that kind of that size of a company, I would say, kind of makes sense. If you're giving away like hundreds of stock options, you also want to protect the interest of your investors. And in that case, we know that they have like quite a lot of investors and quite powerful, right? So it makes sense that they have a very short exercise period, as much as this penalizes those employees that, let's say, worked 4 years for the company and get to the point of exercising the option, but they don't have the cash, so maybe they have to go and bank overdraft and these kind of things just to put together the capital to pay for the strike price. So it can be a little bit tricky, so make sure that if you're an employee or prospective employee in a startup, make sure that you look into that. And on the other hand, I just read an article from Andreessen Horowitz, the VC firm in San Francisco, that is advocating for options that give a 10-year exercise period, basically giving founders the same right as employees the same rights as stock owners. They also highlight some of the possible drawbacks of this approach, but overall I would say if your incentive is to reward your early employees and only keep people with the same kind of financial returns or expected financial returns as you as a founder, the longer the exercise period, the better. 10 years maybe it's a little bit too long, it's like too advantageous, but try to find a right compromise with the employee. Two last variables or aspects that I would like to consider today. These are, I would say, minor compared to the ones I covered today so far, but can also be something that you want to look into before starting to make any stock option agreements with your employees. The first is the tax implications, and this is very peculiar of your geography in your country. In line of principle, if you are a stockholder and you have the strike price and the fair market value of the company, right? So let's say that you were granted a stock option 2 years ago at 10 strike price, and today the company says that the fair market value of the firm is in price per share is 15. The difference 10, 15, so the difference 5. As much as you did not realize that because it's just hypothetical, it can be considered a capital. Well, it is considered a capital gain under a lot of perspectives, especially a tax perspective. So in some legislations, they may ask you to pay taxes on the capital gain, as much as you didn't realize that, because on paper, the taxes are on paper, you are richer by 5 per share, right? Truth is, this is changing. The incentive of the regulator is never to penalize people with the taxes, but rather to to add taxes on realized income, not unrealized, right? So it's something that you may want to look into. I would say that this is a problem that every company, in every legislation went through. So there are most likely ways to work around that, and any legal firm can advise you on that, or you can also look it up yourself, like we did, and also we worked with a legal firm on that. But there are definitely ways to prevent that from happening. You just need to be a little bit careful, and also I would say the legislator is trying to adjust to this kind of new instrument, especially in Europe where it's less known, but it's getting there, right? Final, again, minor aspect that I want to consider is the distinction between bad and good lever. So you want to protect your company. If you're the founder, you want to protect your company from malicious behaviors. So you want to have a definition in your agreement of what defines a bad lever, right? So an employee that misbehaved, that as a consequence does not make him worth to be part of your shareholders in the end of the day, right? So there are like some limit cases, like even the law protects you anyway. Again, this is like more legal terms, but keep in mind that there is a way to limit anyway, regardless of all the terms I consider. There is a way to protect your company from employees that misbehave, and this is called the bad lever as opposed to the good lever. When you are a good lever, so you leave the company, the employee leaves the company in good terms, right? Because it can be any problem. Imagine that an employee needs to move out, needs to, has like health issues. So it can be any problem. Well, that certainly is a good lever, as much as something unexpected. It can be a bummer for the company, but hey, you cannot do anything about it. It didn't misbehave, it just happened. So in that case, it's a good lever, and then you just apply all the terms that we discussed so far. When it's a bad lever is somebody who just exploits the contract for his own purposes, and then clearly has a malicious behavior. For instance, I stole money from the company, these kind of things, right? These are all common practices. Any lawyer will help you with that. So we also made a template based on our experience with data legislation, and we're going to make it available to you in the link here below the video. And for anything else, I would still recommend to look for the assistance of a legal expert. I'm just talking out of my personal experience as a founder to give you a guideline of what to expect. I hope this helps you, and see you in the next video.